Hi, very good evening to all of you. As usual, we'll start with our monthly market outlook. Globally, PMI continues to remain weak, and the tariff war is likely to keep it even further down as the time progresses. The global pessimism has reached its peak as people are worried about what's going to happen with all these uncertainties behind us. These are the estimates before President Trump announced its tariff war. In calendar year 2025, global growth is slowing down. The current estimate is that emerging markets will remain almost similar and developed market will advance a bit. But with this tariff war coming into play, all these numbers are at significant risk. We will be lucky if we don't go into recession. The central bankers are doing what they can do at best, which is pumping liquidity and keeping interest rates on the lower side. The European markets are near all-time high level. They have outperformed American markets. This is partly driven by fiscal profligacy path adopted by European Union. As US pushed Europe on taking bigger share of defense expenditure, they are going back on the fiscal prudence path, increasing fiscal deficit and debt to GDP ratio, and that surprisingly has resulted into their stock market running higher. China, again, this charts are before the US tariff war, but it was widely expected that they are keeping firepower on fiscal side to tackle Trump's tariff. We don't know what will be the end game between US and China, but certainly China would like to depreciate their currency and also provide fiscal stimulus to support growth, which will be adversely impacted by US tariff. Coming to US economy, their challenge with federal deficit remains. It has remained in high single digit over the years, and they are spending more than they are earning. The debt burden has cost $36 trillion. It is now almost 123% of GDP. If fiscal deficit and debt to GDP ratio wasn't a challenge, the current account deficit remains elevated. They are consuming more than what they are producing. With this combined problem of high fiscal deficit and high current account deficit, US needed a course correction. To fund fiscal deficit, they kept on borrowing money, and as debt burden kept on increasing, there was one, fear of inflation, and second, higher interest rates to contain that inflation. The US is now spending $1.2 trillion on servicing that $36 trillion of debt. It is up 2x in last 5 years. What is President Trump's end game? No one knows. We can speculate that he wants to reduce fiscal deficit through Department of Government Efficiency run by Elon Musk, cut wasteful expenditure. He wants to tempt current account deficit by imposing tariff and also earning some revenue to contain fiscal deficit. And he wants to moderate debt to GDP ratio through creation of sovereign wealth fund. Obviously, this is our guess, but this looks like reasonable guess, as with higher fiscal deficit, higher current account deficit, and increasing debt to GDP ratio, US economy needed a course correction. By unleashing tariff war, the uncertainty have reached all-time high. People are not sure how supply chain disruptions will occur. When will policy reverse? What will be the end game of tariff policy? Yesterday we saw in a large market like US, a 2-month-old video of Kevin Hassett, economic policy advisor, talking about 90-day deferment of tariff policy, except for China, immediately pushed the market up. Then it corrected as White House clarified that it is a fake news, and eventually market recovered from the low, even though it closed in the red. This is the kind of uncertainty which US market and rest of the market is facing. Fed continues to play a very, very delicate role. They had just started cutting interest rates and have put a brake as tariffs can increase inflation. Fed Chairman Jeremy Powell has withstood barrage from Trump requesting or ordering for a rate cut. And at the same time, Fed has also reduced the pace of liquidity absorption so that economy doesn't crash. Undoubtedly, while one side the world is focused upon President Trump and President Xi Jinping, equally an important role will be played by Jeremy Powell, Fed chairman, through monetary policy. Undoubtedly, as mountain of debt increases in US, they will prefer lower interest rates. But for interest rates to come down, inflation must come down. And tariff is always inflation accretive, never inflation deductive. Next slide, please. President Trump created new definition of tariff. It is your trade surplus with America divided by your exports to America. Countries which have trade surplus with trade deficit with America like UK and Australia, they also have been imposed tariff of 10%. Countries like Vietnam, which allowed their country to be used by China for assembling in Vietnam, but showing that as made in Vietnam, and who ran hundreds, 100 plus billion, $100 billion plus trade surplus with America, have been hit with duty of almost 46%. We are lucky that we have been hit lower trade deficit vis-a-vis, we have been hit with lower tariff rate vis-a-vis other countries. The past experience of tariff war has been unequivocally recessionary. First tariff hike of this mass scale happened in 1828, resulted into growth dropping down. Then the same was experimented in 1930, that created Great Depression. Let's hope and pray 2025 will be different. This was my summary sometime back about Trump's tariff saga, that they are strong nation. They couldn't care less about WTO. But the past experience of tariff war has not been good either for America or for rest of the world. This tariff war will create lower growth and higher inflation in US. The pain of Wall Street can shift to Main Street. Between inflation and wealth evaporation, there will be pressure on President Trump to rein in tariff war. Hopefully, it will be reined in before it is too late. And India has been hit lower compared to peers, which gives us an opportunity. Let US and China fight it out, and we should be beneficiary from this particular war. In tariff war, no one wins. Normally, on everything, economists have three views: positive, negative, and neutral. But on tariff, most economists agree it is a lose-lose situation. The tariffs make goods expensive in US. Yesterday, I was in a conference where someone from US said, I've stopped eating eggs in my home country because for 12 eggs, I have to pay $13. In India, eggs are available much cheaper. And despite paying $13, availability of eggs is an issue in US. If tariff is imposed, eggs prices can go even further higher. And that can also lift structural inflation expectation. Consumption is about two-thirds of US economy or GDP. More than half of financial saving is allocated to equity. As Wall Street corrects, this could have impact on the consumption, and that could put brake on the American GDP growth. A corollary to the pressure is when people are postponing their discretionary spending, like vacation in recent times. Everyone hates uncertainty. Whenever there is uncertainty, spending will be postponed and hopefully savings will be increased. Coming to India, undoubtedly our FY26 GDP growth will be adversely impacted by American tariffs. Earlier estimates were centered around 6.5% plus or minus GDP growth for FY26. Now it is likely to be centered around 6% plus or minus post-tariff imposition. The headlines for the March 25 were mixed, with growing economy growing at about 6.2% in December quarter, and FY25 growth pegged at around 6.5%, well below 7% when we started the year. Next slide, please. If we see last 10 years, despite all the negative headlines and pessimistic commentary, we are one of the few countries which have doubled its GDP in last 10 years from 2 trillion to 4 trillion plus. Notwithstanding all the negativity of last 10 years, India is one of the fastest growing major economy in the world. Economic activity continues to remain at elevated level and capacity utilization remains around 70% plus level. The quarterly GDP growth number keeps on coming down from April 2024. The June 25 number came lower on base effect. September 24 number came lower on rains and delayed government spending because of election. There was recovery in December 24 quarter, and hopefully this will sustain going forward. The GST collection for FY25 has come little below our nominal GDP growth. It shows that while economy is growing, the pace of growth is slowing down. FMCG volume growth has started improving, led by rural segment. Urban FMCG consumption continues to remain under pressure. Private consumption recovery is underway, and this will get supported in the days to come as 1 lakh crore tax rebate given in last budget comes into play from 1st April. There is also likelihood of petrol and diesel price cuts as oil prices have moved from $80 to $60. There is also some positivity coming from reduction in interest rates on EMI burden of consumers. And towards the end of next year, 8th Pay Commission will put money in the pockets of government employees. Tax rebates, petrol diesel price cut, EMI burden coming down, 8th Pay Commission putting money in the pockets of government employees, all should support consumption. We have been lucky with President Trump's drill baby drill policy. As tariff war is lowering global growth, oil demand is also expected to fall, and oil now is trading at 60 handle. Monsoon has been good last year. It filled our lakes with water, so Rabi season came good. And now all the indicators of El Nino and La Nina are suggesting normal monsoon for current year. There are some weak spots in our economy. The two-wheeler registered negative growth in February. CV and passenger vehicle growth was also subdued. Only tractor segment witnessed 30% plus growth in February on back of strong rural demand. Undoubtedly, overall automobile sector remains subdued. The FDI outflows are coming down on a net basis as outflows have started increasing. Companies like LG, Hyundai, Whirlpool, they are all taking money from Indian companies, Indian market abroad. This outflow of FDI is reducing overall net FDI flows, and it is a cause of concern. As global growth slows down, as tariff barrier comes up, both exports and imports have started slowing. The services exports has been robust. The BPO, the IT services, and the global capability centers put together is keeping our service exports on the growth side. And in recent times, service exports on a monthly basis has started exceeding our goods export. Our share of goods and services exports put together has now reached 2.5% last year compared to 2% few years before. Our challenge remains on the goods deficit side. We have last year about $240 billion trade deficit, of which $100 billion is simply with China. The government will continue to focus on infrastructure spending. In last 10 years, our infrastructure capex has grown at a rapid pace. Hopefully, execution limitations which we saw this year will not be witnessed next year. Private capex continues to remain subdued, and this tariff war is going to increase uncertainty, which will further delay private capex. The corporate balance sheet is strong, and yet their desire to invest is on the back foot. Some support has been given by government through PLI scheme, and PLI and emerging sectors contribute about 27% of industrial capex. Without PLI scheme, our private capex would have looked even more weaker than what it is today. The other challenge for Indian economy is freebies to win state elections. When freebies are distributed, multiplier effect of the same is less than 1 times. If the same money is spent on infrastructure and capex, multiplier effect is about 3x. As we continue to take money from infrastructure and capex to put into freebies, that's going to have adverse impact on our GDP growth. Converting this economic outlook into market, our market cap to GDP ratio has corrected from all-time high of about 140% to now about 108%. We don't believe there is big correction expected in our equity market from a valuation point of view. In FY20, corporate profit was 4 lakh crore. Current year, it is expected to be 18 lakh crore. As profits multiplied 4.5 times, market capitalization has broadly followed. Stocks are slaves of earning power, and as long as there is profitability growth, eventually market will rise. Valuation wise, now we are trading around historical averages, and after taking into current correction, large caps is almost at historical average, not at 7% premium. The small and mid caps are at a premium to historical average, and probably there is some amount of time or price correction left there. Last year, that is FY24, Nifty 50 EPS was about 944. In the first 9 months of the last year, FY25, 776 EPS came. Now about 276 EPS is expected for March 25 quarter. That means for FY25 last year, Nifty EPS will be about 1050. With tariff, there is no way this year's Nifty EPS will touch 1191. It's more likely to be 1011. It's more likely to be about 1150 to 1175. But this correction has already discounted the same. FPIs are big sellers in our market. It's not that they have exited lock, stock and barrel. They continue to own 1/3 of free float ownership. It's more than what mutual funds own. It's more than what retail investors own. It is more than what banks, financial institutions and insurance own. But collectively, between banks, mutual funds and retail investors, now combined we own more than FPIs. While FPIs have been seller of large and mid cap, at least for the quarter ending December 24, they were buyers of small cap. FPI ownership of Indian equity is at a decadal low, as low as it was in 2012, against our benchmark weight of about 19% in MSCI index. FPI ownership is now at about 16%. After years of underperformance to US market, emerging market looks cheaper vis-a-vis S&P 500. With so much uncertainty in US market, will flows start shifting towards cheaper and attractive emerging market? We believe that has reasonably good possibility. Indian market provides growth opportunity. Chinese market even today is where it was in 2007, 17 years before. Their EPS growth will be about 12% in last decade in renminbi terms. Our EPS growth will be about 180% in rupee terms. As we deliver earnings growth, there is no hesitation for me to say that FPIs will keep searching for growth and start investing in India at some point of time. Domestic mutual funds has cash to absorb FPI selling. Obviously, we don't work to give easy exit to FPI. If their selling continues, we will continue to buy at a lower and lower prices, not at a higher prices. With interest rates coming down, Indian equity looks better valued vis-a-vis debt or bonds. Despite last 6 months volatility, almost 300 stocks have doubled over last 5 years. Despite correction in valuation since October 24, 169 stocks as we speak are trading at more than 50 P. One thing we have constantly requested is to moderate return expectation. Last 5 years return in mid and small cap was 20% plus. That pulled overall return to 15%. But 15 years before that, overall market return was just about 11%, driven by large and mid cap. This combination of 5 years of outperformance and 15 years of moderate return created 20-year return at about 12%, with large, mid, and small giving almost similar return. If investors are coming with an expectation to make 20% plus return, they are likely to be disappointed. We all have to work to ensure that investors invest on a long-term basis and with moderated return expectation. Last 5 years return are unlikely to be repeated in next 5 years. Be ready for volatility. No one understands what President Trump will do next. And hence, despite having good fundamentals, our markets will continue to fluctuate on news flow. Keep some dry powder in your portfolio and use this correction as an opportunity to buy into equity. Large caps trade around historical average and hence should be overweight. Overall market valuation is fair Hence, neutral weight to equity as an asset class. Small and mid cap still trade at premium to historical average. So little underweight in the same. That's broadly our call on the market. Coming to equity investment opportunities, on a rolling return basis, our equity fund continues to add value to our investors by outperforming benchmark indices by a margin. The same is the case with hybrid and other equity funds. On a point-to-point basis on 31st March 25, across most of our equity funds, we have delivered better return than benchmark indices. The same is true for hybrid and other equity funds. By and large, we have been able to add value to our customers' portfolio. If we look at SIP return across time period, in most of the cases, we have generated more return than benchmark indices. The same is applicable to our hybrid and other equity funds. Net, we add value to our customers' portfolio by outperforming benchmark indices. As I mentioned earlier, consumer discretionary space looks attractive because of tax rebate, EMI burden coming down on interest rates correction, potential petrol and diesel price cuts, and finally, next year, 8th pay commission will put money in the pockets of government employees. Hence, Kotak Consumption Fund should be something which should be considered in your portfolio. Other than that, Kotak Equity Opportunity, a blend of large and mid-cap fund, is worth evaluating from a portfolio point of view. Next slide, please. This is broadly summary of our views on the market. Not that we are always right in terms of magnitude, but by and large, we have been catching directions correctly. We are in the process of launching our NFO of Energy Opportunities Fund. The issue is closing on 17th of April. Energy is like what Atma is to the body. It is the pran of the economy, and invariably it's the ladder on which prosperity of a country rides. Our power consumption remains way below global average, and as India improves its per capita GDP, power consumption will continue to rise. We are one of the fastest growing energy consumer in the world. As more and more people start using iPhone, laptop, iPad, and such kind of things, no wonder electricity consumption will continue to rise. Rising affluence and evolving lifestyle always drives energy consumption. In a hot country like India, air condition will become first choice for consumer. New age industry like data center, EV, metro will also continue to consume power. Despite record capacity creation, India is looking at power shortages as our capacity addition veers towards renewable energy. Between thermal and renewable like solar, India will have to provide power to its economy. Hydro, nuclear will be longer term projects. Our installed capacity is expected to double in about 11 years, driven by growth in renewable, moving from 32% of capacity to 61% of capacity in 2035. We also run a portfolio of passive funds. Passive funds needs to be chosen for copying an index and also giving a very simple product to an investor who is just beginning his journey in the market. We have bouquet of passive funds between index as well as ETF, and they are in different categories from smart beta to commodity to market cap based indices. We were the first mutual fund to launch MSCI India ETF in the country by tying up with MSCI to use its benchmark indices. Our passive bouquet also includes sectoral and thematic funds as well as overseas fund like Nasdaq 100. Our passive funds continue to have lower expenses than peers. Do have a look at this funds for your customers' portfolio. Coming to debt market, US inflation has stayed above Fed's target range of 2% for some time. And with the imposition of tariff, inflation is likely to remain elevated in US. Fed, deterred by uncertainty unleashed by tariff war, has kept interest rates on hold, but market is pricing that slowing economy and President Trump will push Fed to cut rates. The street is expecting between 3 to 5 rate cuts by US Fed in the days to come. Our inflation continues to remain soft. 2/3 of our inflation came from food price increase last year. And of the food price increase, 2/3 came from vegetable price increase. With good monsoon, both should remain under control, and hence inflation should come within RBI's target range of 2 to 6%. RBI has been managing liquidity very, very proactively, and in recent times, it has intervened heavily through open market operation, VRRR auctions, and FX swaps to increase liquidity in local market. This is time to go and invest for longest possible maturity. The current 10-year yield is 6.5% plus. If repo rate comes down by 3 to 4 times going forward, certainly there is room for 10-year yield to go towards 6%. Hence, it is worth investing in duration. On the debt investment side, income plus arbitrage fund of fund gives you opportunity to invest in a debt product with 12.5% taxation on gains arising after 2 years of lock-in. This fund is appropriate for high taxpayer investors if they want lower taxation burden. 60% fund is into pure debt and 40% is invested into arbitrage fund. Collectively, it will have lower tax burden. The other debt fund which are worth considering is hybrid schemes between Kotak Debt Hybrid, Kotak Dynamic Balance Advantage Fund and equity savings. There has been lower volatility and higher return over a period of time. Nothing comparable to pure equity, but certainly collectively they have delivered lower volatility and higher return compared to debt fund. Gold, we have remained bullish since COVID time, and bearing 1 year in 2021, by and large, our calls have come right. Today, our household owns more gold than top 10 central banks put together. The demand of central bankers around the world and Indian household is supporting gold prices higher. There is race between Indian housewives and central bankers around the world who will buy more gold. Today, both of them are averaging about 1,000 tons of gold on a gross basis. The world does not have enough gold to meet demand of both central banks of the world as well as Indian housewives. While gold is being talked about, do look at silver. The silver versus gold has come down to below historical average, indicating that silver probably will get supported in the days to come.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.